Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Tether Depeg attempt. A bombshell report suggests that Sam Bankman-Fried tried to depeg USDT to save FTX. Why some are speculating that Sam was behind the collapse of Terra, 3AC, and Celsius. Crypto media money. CEO of The Block resigns after it's revealed that he and his company received tens of millions of dollars in loans from Alameda. What does this mean for crypto media outlets? Ethereum upgrade confirmed. Ethereum developers set a tentative date for the highly anticipated Shanghai hard fork. Everything you need to know. Cash ban incoming. Nigeria limits daily cash withdrawals for its citizens to force the adoption of its e-Naira central bank digital currency. Which other countries are starting to restrict cash use? Digital ID developments. Australia officially launches its national digital ID, while the European Union finalises details of its digital ID wallets. When will this dystopian technology land on your doorstep? And of course, some more expert analysis from the one and only Benjamin Cowen. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. According to the Wall Street Journal, Sam Bankman-Fried was actively trying to depeg Tether's USDT stablecoin prior to FTX's collapse. Now, in contrast to most mainstream media reports which cite people familiar with the matter, journalists at the WSJ cited messages from a Signal messaging group as evidence. What's wild is that this Signal group included not just Sam, but Binance CEO Changpeng Zhao, former Kraken CEO Jesse Powell, Tether CTO Paolo Ardoino, and even Tron founder Justin Sun. It's safe to say that this wasn't any ordinary Signal group chat, and it certainly reveals a lot about the crypto industry. Now, according to Paolo, Alameda Research, the crypto trading firm that Sam co-founded, was trying to push down the price of USDT to intentionally crash the crypto market. Members of the Signal Group believed that Sam was doing this to lower the value of Alameda's liabilities, that is, its crypto debts. As a matter of fact, there is on-chain evidence which proves that Alameda was actively dumping USDT. Sam said in the group that the small 250k sell-offs shouldn't be an issue, but CZ fired back, saying Alameda's repeated selling could push USDT below its peg, and that's exactly what happened. For context, Alameda started shorting USDT on the 10th of November. USDT briefly fell below its peg on the same day, which spooked many in the crypto community, considering Alameda is the largest recipient of all the USDT ever printed. The next day, FTX and Alameda filed for bankruptcy, and USDT regained its peg. Sam told the Wall Street Journal that, quote, "To my knowledge, neither myself nor Alameda has ever attempted to intentionally depeg Tether or any other stablecoins." Now, if you watched our video summarizing Sam's recent appearance at the New York Times' Deal Book Summit, you'll know he's a sneaky so-and-so. In this case, Sam is basically saying that he didn't do it and is covering his backside by saying any depegging was not intentional. Ahead of the day it's inevitably discovered that Sam was, in fact, in the driver's seat all along. The second part of the quote is similarly revealing because nobody ever asked Sam about other stablecoins. From what I can tell, the second part of the quote is a subtle reference to New York City regulators investigating Sam's involvement in the collapse of Terra's UST stablecoin in May. What's interesting is that the entity which initially caused UST to depeg is still unknown, at least according to Nansen's research. The NYC investigation, coupled with Sam's recent comments, suggest that Alameda may have had a hand in that crisis, with Terra co-founder Do Kwon adding fuel to the speculative fire on Twitter. Do alleges that Genesis Trading provided Alameda with $1 billion UST. Note that Genesis Trading is also in trouble. As many of you will know, crypto hedge fund 3 Arrows Capital was the next entity to collapse after Terra. 3AC founders Zhu and Carl Davis both allege that Alameda was behind their demise as well. It didn't take long for Celsius co-founder Alex Majinsky to claim the same. Alameda is the one to blame. Now, it's obviously too soon to say just how involved Sam, FTX, and Alameda were in all these crypto crises. It may end up being of little consequence given that Terra, 3AC, and Celsius were all extremely over-leveraged. This was ultimately the cause of their demise, regardless of who the first mover may have been. Now, if all these FTX Alameda revelations weren't already crazy enough, last week another bombshell report from Axios revealed that Alameda had given tens of millions of dollars of loans to The Block, one of the biggest and most well-known crypto news sites. Alameda gave $27 million to The Block in early 2021 to help CEO Mike McCaffrey restructure the company. Mike did not disclose that this money came from Alameda, nor did he disclose the fact that he had received an additional $16 million from Alameda this year to buy property in the Bahamas. Not surprisingly, Mike resigned the moment the news broke, and Bobby Moran, the Block's chief revenue officer, became CEO. Bobby published a blog post explaining the situation, and he claims that nobody at the Block knew about Mike and Alameda. Senior employees have since claimed the same. These claims have been met with some skepticism from the crypto community. This includes former employees of the Block who told crypto sleuth Autism Capital that the company's senior executives must have been aware of Mike's relationship with Sam. Heck, there's even a photo of them together. In any case, the news has taken the crypto community by surprise and has arguably raised concerns about who has been funding the other crypto media outlets. For what it's worth, I always found The Block to be one of the least biased of the crypto media outlets, and it has quality journalists on its staff. Unfortunately, the same can't be said for some other crypto media outlets. I dare not name any names, but I strongly suggest looking up who has been backing your favourite crypto media platform. Also, consider examining how the same stories are being covered by different crypto media outlets to identify any bias. The funny thing is that even the most biased crypto media entities are exponentially less biased than their mainstream media counterparts. This has made some crypto media outlets serious competitors to those in the mainstream when it comes to the coverage of cryptocurrency and related events. As the popularity of crypto media outlets increases and that of mainstream media outlets wanes, there's a very real possibility that the two worlds will come into conflict. Some would say this conflict is already happening and will only accelerate as crypto adoption continues. This begs the question of what lengths mainstream media outlets would go to crush their competitors. Consider that the revelation about The Block are likely to result in extreme scrutiny of not just it, but every other crypto media company. It doesn't help that they're all apparently based in New York City either. Now, I must stress that this is speculation, but I suspect we could soon see a crackdown on crypto media outlets because of Alameda and The Block. This is not far-fetched, given that governments have been ramping up their censorship efforts on social media. More about that in the description. Now, speaking of speculation, there's been no shortage of just that around Ethereum's Shanghai hard fork. For those unfamiliar, the Shanghai upgrade is when validators on Ethereum's proof-of-stake beacon chain will be allowed to unstake their ETH and claim ETH staking rewards. Last week, Ethereum developers announced that the Shanghai hard fork has been tentatively scheduled for March of next year. Now, this is as exciting as it is scary because it could lead to a large amount of ETH selling by Ethereum validators. It doesn't help that April is the deadline for most taxes either. The silver lining is that tokens belonging to crypto projects and protocols related to staking, such as Lido Finance's LDO token, are likely to rally leading up to the Shanghai hard fork. The caveat is that we may still be in a crypto bear market in March, meaning the rallies may not be impressive or even result in selling. Now, if I understand correctly, unstaking won't be the only upgrade to Ethereum as part of the Shanghai hard fork. Another Ethereum improvement proposal, or EIP, called Warm Coinbase, will reportedly make transaction fees on Ethereum lower. You can look it up if you're interested. It's EIP 3651. Another highly anticipated EIP to keep your eyes on is EIP 4844. The TLDR there is that it will make Layer 2 scaling solutions on Ethereum, such as Arbitrum and Optimism, up to 100 times faster. Given that these Layer 2s can already process between 2,000 and 4,000 transactions per second, that means 20 to 40k TPS. This would put the speed of Ethereum's most popular scaling solutions on par with smart contract cryptocurrencies such as Solana and Aptos. More importantly, it would put them on a par with payments networks such as Visa and MasterCard. Note that Vitalik was talking about crypto payments just recently. EIP 4844, also known as proto-dank sharding, was initially going to be a part of the Shanghai hard fork, but has been pushed back to May or June of next year so that Ethereum developers could focus on unstaking. I reckon that's a reasonable thing to do given the significance of the upgrade. Now, if you're wondering what all this means for ETH, the short answer seems to be that it will be bearish in the short term, but extremely bullish in the long term. That's again because Shanghai could result in lots of ETH selling, whereas EIP 4844 will significantly increase scalability. If you're wondering what all this means for the so-called Ethereum killers, the short answer is that it depends on which one you're talking about. If you're subscribed to my weekly newsletter, you'll know that EVM-compatible Ethereum competitors are looking ever less competitive as Ethereum improves. That's because the only thing that really separates them from Ethereum is their scalability, and Ethereum's scalability will again be improved significantly by EIP 4844. By contrast, non-EVM smart contract cryptos such as Algorand and Cardano may finally get an edge, as they will be capable of unique non-EVM use cases. I'll be doing a Cardano update later this week. For now, though, I suggest you check out our video about the fastest cryptocurrencies so that you understand how TPS works. After all, the best time to learn is during a bear market. Anyways, another recent headline that's been going viral is the news that Nigeria has limited cash withdrawals for its citizens and businesses. Nigerian citizens are now only allowed to withdraw up to $45 worth of the country's naira currency per day, with the largest denomination allowed being 45 cents. Naturally, this cash restriction is meant to force Nigerians to adopt the government's e-naira, the central bank digital currency. For reference, the e-naira was introduced in October last year, yet only 0.5% of the population has adopted it, according to recent statistics. As some of you will know, Nigeria leads the world in crypto adoption. Anywhere between a quarter to more than half of Nigerians use cryptocurrency, despite their government banning it in February 2021. It just goes to show that crypto can't be stopped, but it also presents a chilling precedent of what's to come. Now, the other country that springs to mind is Israel, which announced restrictions on cash payments back in August to help drive digitized payments. In this case, the limit was around $4,400 USD. Like almost every other country out there, Israel is also developing a CBDC, in this case its digital shekel, expected sometime in 2024 or 2025. Many European countries have also moved to restrict cash payments in recent years, such as Lithuania, which set a cap of €5,000 on cash payments just last month. And of course, the European Central Bank is actively working on a digital euro, which could be released as soon as 2026. This relates to a trend that I've been talking about on the channel for quite some time. Every country that will be rolling out a CBDC has taken steps to restrict cash use introduce anti-crypto regulations, and pass legislation related to digital IDs that will be required for CBDC systems to operate. I'll quickly note that anti-crypto regulations aren't limited to crypto bans. Some countries, such as India, have opted to introduce incredibly high tax rates on all crypto transactions. Recent announcements by the European Union and others suggest that they are headed in a similar direction on that front. This is simply because central banks and governments do not want their CBDCs to have any competitors, including physical cash. Case in point, the ECB admitted in a recent paper about its digital euro that it wants to ensure that citizens can't hoard cash when the central bank introduces negative interest rates. More about that in the description. I digress. Now, before you get too black-pilled, it's important to remember that cryptocurrency is in fact an alternative to the current financial system. Although it's not perfect, it is in development, and it should get to a point where it's a viable alternative for people in developed as well as developing countries. With some luck, this will happen before governments manage to roll out their central bank digital currencies. From where I'm standing, this is more than likely to happen just because we've seen time and time again that citizens do not adopt dystopian technologies voluntarily. Now, as I mentioned in yesterday's video about digital IDs, their dystopian qualities mean that the only way governments can convince the average person to adopt them is to use a crisis to justify their use. De facto digital IDs were tested during the pandemic, and some countries are ahead of the curve. Australia arguably leads the field here, as it had such severe pandemic restrictions that some were seriously starting to wonder whether the country had once again become a prison colony. Never mind the surveillance issues, which have managed to make the crypto headlines because they're just so bad. In what appears to be a continued return to its roots, the Australian government officially launched its MyGov digital ID last week, complete with a built-in digital wallet. As in many other countries, Australia's digital ID rollout is just one of many milestones on the road to top-down digital totalitarianism. If you think I'm exaggerating, consider the following explanation of Australia's MyGov digital ID. Quote, "The app is designed to become a single digital location to manage identity and provide mobile access to both government and private sector services." Europe's upcoming digital ID sounds eerily similar. Now, while governments around the world have promised that the adoption of digital ID will be voluntary, the Australian government outdid itself yet again by telling businesses last month that they must register a digital ID number by the 30th of November or else face fines of up to 1 million Aussie dollars. Meanwhile, the government of Namibia recently revealed what comes next for countries rolling out digital IDs. Starting next year, Namibians will have to link their digital IDs to their phone numbers or else they will lose their mobile phone service. By the sound of it, the European Union is planning something similar for internet access. I suppose the entity ahead of the curve in this case is Twitter, with Elon Musk encouraging real identities to be connected to Twitter profiles. Remember that digital ID is digital ID regardless of the issuing entity. Conspiracies aside, the fact of the matter is that digital IDs are required for the successful rollout of CBDCs. They're also required for all the other terrifying technologies that technocrats are trying to introduce by 2030. Preventing these from becoming a reality means vehemently opposing digital ID. The good news is that the average person is inherently opposed to it. The bad news is that the governments know this and will therefore take advantage of every crisis they can to force their rollout. This could include purposely creating crises to that end, and some would say that's already being done. All right. That's enough conspiracy for one day. Let's now turn to Ben's amazing analysis of what he's seeing in the crypto market.
Hey Guy, thanks again for having me. As always, it is a pleasure to be here. Today, I thought I would mix it up a little bit, and instead of only talking about Bitcoin, I'm actually going to talk a little bit about Bitcoin, Ethereum, and Cardano. So I'm going to look at a different chart for each of them to try to get a sense of where we are within the market cycle. because of the interest in minor capitulation recently, and obviously the ongoing discussion about that, I thought it might be interesting to take a look at the Pure multiple, which is a measure of miner profitability. Specifically, the Pure multiple is calculated by dividing the daily issuance in USD divided by the 365-day moving average of daily issuance in USD. And while tops of this indicator are not necessarily the most predictable, what you will notice is that the bottoms tend to occur right around the same level. In 2011, the Pure multiple bottomed right around 0.294. In 2015, the Pure multiple bottomed right around 0.312. And in 2018, the Pure multiple bottomed right around 0.304. So in every single case, the Pure multiple for Bitcoin, which again is a measure of miner profitability, bottomed at around 0.3. Now, I remind myself that these metrics that we use and that we've relied on in the past, they were created during a secular bull market in equities. And so I still would like to, I would expect that you would see some of this play out again this bear market as well. And so it really calls into question, well, where is it today? And within the context of where it has historically gone. And so far, right now, the Pure multiple is actually sitting at around 0.601, but the lowest it has gone was back in June, in fact, not at the most recent low, when it hit 0.347, at least by the daily close. So when I look at this chart, and I sort of hover over these major bottoms in the past, and look at where we are today, it still does keep me somewhat cautious, especially going into the next few months. It doesn't mean that we haven't made it a significant way through the bear market. I think we have, but these are the types of charts that will likely keep some investors remaining relatively cautious when just looking at where we have historically been with miner profitability, which was developed during a secular bull market. And so right now, you can also change this to a moving average just so it kind of gets out some of the noise. And if you look at where we are in the context of prior major historic bottoms, you can see we're currently still sitting well off of those lows. So this is a good indicator, I think, to sort of get an idea of where we are within the Bitcoin market cycle and in the current bear market. If you go take a look at the Ethereum price chart, one of my favorite indicators is using logarithmic regression fit to quote unquote non-bubble data. Now, ideally, and I say this quite often, especially with Bitcoin, is this needs to be refit after every bear market. But what you notice is that during the bear markets, Ethereum tends to find its way back to the lower regression band fit to non-bubble data. Now, non-bubble data is somewhat discretionary, but the whole idea is basically trying to fit it to data where long-term investors really see the value and the tourists are no longer in the space. So the tourists arguably are what sends us out of these lower regression bands into these mania phases. And then we have these bear markets that bring us back down to that regression band, which is where you find that real value, like we saw back in 2018, 2019, and 2020, like we saw back in 2016, and like we saw back in 2015 as well. And so this bear market, you can see Ethereum is still sitting just above this lower logarithmic regression trend line for Ethereum. And if you're curious, what type of valuation would be somewhat akin to what we saw back in 2018, according to the regression band, it'd probably be somewhere between that $400 to $600 range is what would give you similar types of value as what you saw back over here in 2018 when Ethereum capitulated to less than $100. Now, if we unpack that a little bit, if you look at where the price of Ethereum was back over here in October before it capitulated, it was around $200. In the grand scheme of things, that $200 level was still a fairly attractive price for Ethereum and a fairly attractive accumulation range for the next several years. Okay, so in the same way, Ethereum today is trading for $1,200 or so. Plus or minus $100, of course. It depends on the day. So in the grand scheme of things, of course, it probably isn't the worst price. But in terms of the same type of value that we saw back in 2018, I think you're still talking about a new leg lower for Ethereum to get it to those lower prices. Again, there's no guarantees, of course, that we make it there. but in reference to what would give you the same type of deep value that investors saw back in 2018, I think you have to look to that lower logarithmic regression band for Ethereum and make the comparisons to every single bear market. We eventually made it to that logarithmic regression band. Sometimes it took longer than other times, but in every instance, Ethereum eventually came home. And then finally, if we look at the Cardano bear market in the context of its prior bear market from 2018, the first thing that you'll notice is that the 2018 bear market for ADA looks like it lasted a really long time. And in fact, if you just look at the bear market from 2018, this is sort of what it looks like, this blue line from, that represents that 2018 bear market. The reason why it extends so much further out is because technically speaking, in 2020, ADA actually put in a new low that was lower than where it went in December of 2018. So perhaps you want to call this the bear market for ADA in 2018 and this sort of an accumulation phase with a slightly lower low. Regardless, the way I look at it is I compare it to the current bear market and say, you know what? It's not that dissimilar from what we saw last time, and it's also more or less what you would expect. Every cycle, there is sort of like a new wave of adoption where that cryptocurrency has more value, theoretically speaking, than it did the prior bear market because it's continued to build throughout the last market cycle. And so ideally, you would see a bear market that doesn't go down quite as bad. And so far, that's what we've seen. For the most part, this bear market for Cardano and its native token ADA, for the most part, basically for the entire bear market, the drawdown from the prior all-time high has not been as bad as a function of time as it was back during the 2018 bear market. If the slow bleed continues by ADA, it wouldn't be that far off from where it was during the last market cycle bear market. So something to keep in mind. And the reason why I like pulling all these together is because you have the Pure multiple with Bitcoin that is sitting just off of these historic lows. You have Ethereum's lower logarithmic regression band, which again is sort of sitting just above the lower regression band, which has been a fairly decent time for accumulation of Ethereum in prior cycles. And then you have ADA's bear market, which still looks very similar to what we saw last time. All three of these charts are enough to keep long-term investors cautious, but it doesn't mean you can't start to find some long-term value in the coming months. Thanks again for having me, Guy. Pleasure to be here as always. Look forward to being here again next week.
Thank you, Ben, and see you again next week, same time, same place. And that is all for today's Coin Bureau Weekly Crypto Review. So if you enjoyed it, folks, you know what to do. Hit that like button, subscribe button, and bell icon too. If you're looking to maximize your gains during the bear market, the Coin Bureau Deals page is where you should go. You can find the link to that resource and many others in the description below. So, thank you all so much for watching, and I will see you in next week's episode.